Good day, ladies and gentlemen, and welcome to the Softrax Executive Webcast Conference Call. My name is Damali, and I will be your operator for today. At this time, all participants are in listen-only mode. If at any time during the call you require assistance, please press star followed by 0, and an operator will be happy to assist you. As a reminder, this conference is being recorded for replay purposes. I would now like to turn the presentation over to your host for today's call, Mr. Bob O'Connor, President and CEO of Softrax Corporation. Please proceed.
Thank you very much, and welcome everyone to today's webcast. Softrax is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today. So welcome to our customers and everyone else. We have well over 1,000 registrants for today's webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, John Barnes of Grant Thornton, who's here to make his presentation entitled Your Organization Under IFRS. He joins us from Virginia, so we're doing a multiple-site webcast as usual. And as always, John will be here. Our speakers are always here afterwards for questions upon the conclusion of the webcast. Let me just take a few minutes to give you an outline of today. We'll get all this done by the top of the hour. I'll spend a few minutes on Softrax and how we fit into today's topic, and then I'll turn the great majority of our hour together over to John, who will make his presentation along the agenda that you see on the screen. For those of you who are unfamiliar with our webcast format, we do leave some time at the conclusion of John's presentation to answer your questions. And in order to do that, to ask a question, you can look at your console now, and you'll see in the lower left-hand corner the Ask a Question feature. Click on that. Type in anytime throughout John's presentation. I will be reading the questions, and I'll ask as many as possible after he concludes his prepared remarks. The most commonly asked question, and we've already received it on this webcast, is can I get a copy of the slides? John's got a lot of information here, and you will want copies, so the answer is yes. But we do make you work a little to get a copy of the slides at the conclusion of the webcast. We really want your opinion on the webcast, and we want your feedback. So you'll see a survey page, and we'd ask you to complete the survey. Upon doing that, you'll get the slides. You'll also get an email with a link to the recording in case you or someone else in your organization wants to listen to this again. So that's really the housekeeping information that we want to get through. Just a few words on Softrax. We develop software, enterprise software, that manage all aspects of a customer's revenue cycle. And throughout the U.S. and throughout the world, several hundred companies from many different industries use our software to manage their complex billing, revenue recognition, revenue allocation, revenue reporting, and forecasting. And as you may know, Softrax started by serving the complex revenue needs of software companies, and we're the clear leader in that market space. And as you can see from the screen, we have grown to address the unique revenue needs and complex revenue needs of many different industries. And our application suite are designed around the operational and strategic needs of the CFO and his or her team of people in the finance organizations and throughout the company. They're frequently challenged by multiple business models, compliance issues, and reporting needs. And our applications, we have billing and operational applications that help in terms of contract management and renewals and billing and complex billing, unparalleled revenue recognition capability and expense accounting ability, and analytical applications that are needed to improve visibility and make strategic decisions. And all of this functionality can be licensed individually and is frequently packaged into offerings for billing and revenue management solutions. And in many different industries, we use our decade of experience and domain expertise and large customer base to be able to address the unique needs of the industries as listed on your screen, from software companies through e-learning and more. And for larger enterprises who are already implementing or planning to implement an ERP system, our Revenue Manager product is the most robust application and is very complementary to existing ERP environments. So our mission is to help our customers enhance their revenue, reduce costs, all the while complying with ever-changing regulatory issues. Certainly the first two and even the third are important in this environment, where our customers benefit from found revenue, enhanced revenue, reducing the cost of doing business, and a great ROI on the products. Certainly the topic of today around revenue recognition, we We see revenue recognition as the missing link with respect to enterprise systems, and with many people still relying on spreadsheets to do so. And the impact of managing revenue outside of an enterprise system are many. Certainly there's great compliance and restatement risk. The revenue numbers are always of high materiality. Many studies have found delays in closing processes based on complexity of the business models and the volume of data. Most companies, even large public companies, are not accurately managing or predicting revenue from a forecasting perspective and relying on broad assumptions to do so. And the reason for such widespread manual processes are reflected in many other studies. I urge you to go to the website revenuerecognition.com for all the details. All these graphs you see are really representative of studies that revenuerecognition.com has done, and I direct you to there for the details. But clearly, the use of spreadsheets are based on the fact that revenue is really the most complex area to manage, again, due to business models and transaction types and volumes. Studies continue to show that it's the most complex area, the most challenging area to establish internal controls, and fundamentally ERP systems and other kind of generic financial applications that try to appeal to many different industries are not designed from the ground up to manage revenue. And the reason that is because fundamentally for many industries, and that list is growing, they just can't function with respect to the classic order-to-cash process that an ERP system or generic financial application is designed to do, really as early as the contract and throughout the life cycle of a contract and order and billing and so forth. There needs to be a parallel yet integrated process to manage revenue. And unfortunately, we see many companies who are trying to address the revenue issue with a host of disconnected or manual or custom systems around generic financial applications or generic or ERP systems, and certainly this type of arrangement creates many problems when one is trying to scale a business throughout the world or integrate acquired companies. And what we're here today to learn from John really is about IFRS. This challenge continues to grow. Today, most people think they have their hands full with U.S. GAAP and compliance issues, and isn't that enough? Yet now in today's webcast, you'll hear in some other webcasts that we've done already, you'll hear that the looming issue of getting ready for IFRS, as well as the historical revenue systems, information systems, and infrastructure that will be required to do so, and certainly that the future becomes more and more complex as we look forward. Certainly our customers believe, we believe, and the market generally agrees that one of the ways to help manage through this, the complexity of today, tomorrow, and the future is the use of an operational and strategic system that can help you build a revenue infrastructure upon which to build a business. So that concludes my remarks. Let me introduce John Barnes of Grant Thornton. It's our pleasure to have you here today, John. John is a partner in the advisory services group at Grant Thornton. As I said, he joins us from Virginia today. His experience have included providing external audits and internal control consulting within the COSO framework, and then coordinating such work with all of the big four accounting firms. Most importantly, John is the go-to guy with respect to IFRS, especially around the process and technology of things. John assists with the coordination of the firm's advisory services offering around IFRS. So we have the right person here for the job. And welcome, John. And the floor is yours.
Thank you very much, and thanks everybody for joining today. Look forward to talking to you for the next 40 to 50 minutes about a very popular topic. Not a day goes by in the current financial press that we don't see something related to IFRS, and either that those comments are either supportive or negative. Just want to go over with everyone a brief agenda of what we're going to cover. Just going to tell you a little bit about Grant Thornton in case you don't know much about us, and give some background over the development of the International Financial Reporting Standards. Then we'll get into the people, process, and technology implications. Give you some top 10 things to consider for converting from GAAP to IFRS, and then talk a little bit about our approach to these services. So, Grant Thornton. We are an international accounting firm, and we are the 5th largest global accounting firm. with over 29,000 employees worldwide. We have approximately 50 offices in the U.S. and in over 112 countries worldwide. So if you are located in another country and need access to our expertise from an accounting firm, we can certainly make sure you get connected to the people that are most readily available locally. So what is IFRS? What's the proposed roadmap? And some overall risk and benefits that we see as companies look to make this transition. Well, international financial reporting standards are just that. It's a common set of accounting standards that are trying to increase the transparency, comparability across the information presented in financial statements worldwide. What a lot of people aren't aware is this is not something that just popped up in the past few years. You can really look back to the 1970s when the original International Accounting Standards Committee was formed, and they've been working towards this international global set of financial standards. And most recently, the FASB and the International Accounting Standards Board have been working on a process to convergence. So, in November of 2008, the SEC released an IFRS roadmap. If you look at that date, some may say, gee, that was right around the time of transition, the beginning of a transition in leadership. So we'll talk about that a little bit later, but it's definitely going to have some impacts. It is the general belief by, I would say, the standard-setting bodies in the U.S. that there would be a benefit for adopting IFRS and increasing the comparability across financial statements worldwide. By doing so, this will allow companies in the U.S. to compare their financial statements to the UK or to China, and everybody can be talking the same financial language while still speaking their native tongues. As part of the SEC roadmap, they really established some milestones of things that they'd like to see before they ever got to what this roadmap was. The first was a general improvement in overall accounting standards, and next was the funding and accountability for the standard-setting body for international accounting standards. It was very important to the current standard setters to figure out how is that group going to be funded, how is everything going to report into each other, what is going to be the relationships from that regard. Improved ability to use XBRL for IFRS, and in fact there is a taxonomy for XBRL that exists right now. Education and training on IFRS in the U.S., which we'll actually touch on a little bit later. Limited early use by eligible entities. And then the next two were anticipated future SEC rulemaking, how that would fit into the overall international standards, and the potential implementation of mandatory use. Now, the proposed roadmap that was issued in November of 2008 really takes a phased-in approach to public companies and their adoption of IFRS. And really, the first year that large accelerated filers must convert to IFRS would be 2014, and there would be a phased-in approach from 2014 through 2016, much like there was under the Sarbanes-Oxley rules. So, as you can see, that there is what appears to be a long window, but as we'll discuss later in the webcast, there's not as much time as one may originally be led to believe.
John, well, first I want to remind people to ask questions, and I'll read them throughout the presentation, but just through the Ask a Question feature, just to click on that and do that. But, John, you said you'd mention it later, but we already have a few questions on it, so I thought I would interrupt. So you mentioned the timing of IFRS And what is the thinking given the current administration and new SEC commissioner at this time?
That's a great question, and I wish I had a crystal ball and could tell you everything that they were thinking, but Mary Shapiro did make some interesting comments, and they revolved around the fact that the SEC is not going to be bound by what the former administration set out, and that they're really not going to draw the line in the sand until they get further out into 2011. And I think from everything that's gone on in the economy, everything that businesses are currently experiencing, I would say that there's probably this has been pushed down a little bit in terms of everyone's priorities. But it's my thinking that things are going to recover, and do we get to 2011 and then everybody says, oh yes, this is a priority again, we're going to convert, and companies may have not taken the necessary steps to get themselves prepared in enough time.
All right, great, thank you. Keep the questions coming, everyone.
So just to go over some basic differences on IFRS versus U.S. GAAP. Everybody who's looked at all of the GAAP pronouncements recently could probably stack a few piles of books on their desk to show the weight and the volumes of paper that are generated. So currently under U.S. GAAP, it's very much more rules-based. You can go and look at the standards and follow things through based on your industry, based on the type of transaction, which really leaves fewer choices and more specific guidance, which has in the past led to what should be easier to apply and more easily enforced rules. However, if you look at IFRS and the current set of standards, they are much broader. They give companies more choices. They're less specific and less prescriptive. And really they're looking for companies to provide more professional judgment in what they're doing and how they're doing it and how they reach their conclusions. However, their judgment may make enforcement more difficult, and it may be harder to evade, though, these broader principles. So those are just some general differences. Some brief examples that we can go over under the IFRS versus U.S. GAAP. The first item, extraordinary items are permitted under U.S. GAAP. However, they are explicitly prohibited under IFRS. In addition, basis of measurement for PP&E, basis can be revalued or a historical cost under IFRS. Currently under GAAP, it's under historical cost only. These are just some brief examples. There are many more examples that you could find out and research as you go through your company's accounting policies and compare them to the current standards. And that's one thing we encourage companies to start doing to sort of understand where these major differences might exist. As we talked about before, there are some risk, complexities of technical accounting standards and the changes. There might be limited IT professionals with IFRS knowledge, and we're going to get into some of the technology impacts, and we really have seen across the world that this is a very large impact. Some benefits are the increased transparency and credibility, a consistent set of standards, an expected more efficient allocation of capital across international boundaries, and hopefully companies that are already employing IFRS that are international based are seeing these results. So from a process standpoint, what are IFRS considerations? How may it affect accounting policy, financial reporting, internal controls, global operations, all the way down to tax preparation, human resources, contract negotiations, risk and benefits, and we'll go into those in each more detail. So all of these things are going to be impacted by IFRS. How the disclosures are done, the format of the financial statements, how revenue is recognized, and the like. So there are a multitude of changes that are going, from an accounting standards standpoint, that are going to impact the rest of the processes that companies use to do their financial statements or internal reporting. Some key ones from a financial reporting perspective, the financial statement presentation is going to significantly change. There will be some terminology changes. There's going to be a presentation of owner changes in equity in a separate statement from non-owner changes. There's going to be additional comparatives needed when an entity retrospectively applies a new accounting policy. Additional disclosure of items recycled to profit or loss from equity. So it's just going to have some major changes that preparers of financial statements in the United States have not seen recently. What we are recommending are for audit committees and board of directors to currently start to look out and find, do they have somebody on their audit committee and board that has sufficient knowledge of IFRS? Are they gaining, is the board or audit committee gaining an understanding of the impact these changes are going to have on the reporting of the financials and their related internal controls? What is their understanding of IFRS disclosure requirements? And where will these financial statements be filed with regulatory agencies? Or is it going to increase? Is it going to decrease? And what is the timing for that? And really, when you look to the accounting policies and procedures that a company has right now, most of those are based on I would believe most of those are based on U.S. GAAP if you are based in the U.S., or if you're based in another country, they're based on your local GAAP if you have not already converted to IFRS. So these policies and procedures manuals are going to become obsolete, and they're going to require updating. Your staff is going to need to be trained to comply with these new policies and procedures. There's going to be a new principle-based hierarchy, and one of the chief things that should be a benefit that companies can rely upon is, whenever we do this conversion, the policy should be uniform for the parent and all the subsidiaries, and that's really no exemptions, even if the business is different in different locations. So that should be a benefit that companies are able to achieve. So internal control adjustments include looking at the business processes, and if you've had the fortune of going through the internal control documentation standards of Sarbanes-Oxley, it's really assessing needs to possibly change scoping methodologies, understanding the development of internal controls for the new procedures, ensuring that your control documentation is complete and up to date, and that people are trained on the appropriate changes in that area, developing testing approaches that reflect these new financial accounting standards, and it's just going to be utilizing a whole new base of professional standards. One thing we see on tax preparation is it's going to be a elimination of LIFO from inventory accounting method. It will have an impact on effective tax rate calculations, on the calculation of provisions, on what's considered a temporary versus permanent difference, and there's a lot of progress been made recently on the differences under the FAS 109, which is the current U.S. GAAP, and International Accounting Standard 12, which is the tax standard, and they're working towards convergence of those, but there are still significant differences. However, there are some, the good news is that the tax rules themselves, the IRS tax regulations currently, they're always changing, but they're not changing in relation to this upcoming set of standards coming out. Contracts, and this really looks at sales contracts, commission-based contracts with salespeople, debt calculations, and the like. All of those calculations that are driven based on the current set of financial standards are going to need to change. And if those changes are going to cause you to become out of compliance with your current set of contracts, whether it be debt, equity ratios, and the like, it's something that companies need to start addressing and assessing and approaching certain, either internally, the stakeholders, the sales force, and the like that are going to be affected, or external stakeholders, and really start to engage the dialogue as to how those changes are going to impact them. So some risk and benefits of this are there are obviously complexities of implementation. Standard-setting body is not located in the United States. One of the comments that some of our peers in other lands have quoted as saying, are we going to return to a state of protectionism because of our current economy and the like? So I believe that there are some risk that we feel that this standard-setting body, that we're going to lose control over it if we ever really had control. There might be an increased litigation due to the wider principle-based approach, but that's weighed against the opportunities for increased efficiency and transparency. One book of standards for IFRS versus several under U.S. GAAP, and those are just some of the many benefits and risk. So the people implications, who's affected by IFRS, companies, public companies, private companies, academia, and what are the risk and benefits to the people? Well, really, it's the entire business community. There's nobody that is not going to be impacted by IFRS. And it's not a matter of when, it's just, a matter of if it's going to happen, it's just when is that date going to happen. For public companies, early adoption of the IFRS requires a reconciliation to U.S. GAAP. And regardless of whether a company undergoes early adoption or waits for mandatory adoption, it's our belief that companies should start preparing today. One of the many comments we get from our international companies that are working with Grant Thornton member firms abroad is that they wish they would have started earlier, and it's the same story. It's an ounce of prevention really saves a lot of money down the road. So private companies. Well, recently there has been an issuance of what IFRS for private companies is going to look like. But I think we've seen, and if history is any guide to what will happen in the future, usually changes in the public company sector have an impact on private company GAAP, because there is a desire not to really have two sets of GAAP. So there's no regulatory requirement that private companies are going to have to adopt IFRS. There are certainly some sound reasons for private companies to possibly consider it, and that might be access to the markets and possible transactions that a company might anticipate down the road. So the AICPA already recognizes IFRS as a legitimate alternative to GAAP. So it may be something that private companies also want to look at. Academia. I have the chance to do a lot of recruiting at colleges and universities, and just now they're beginning to make a movement towards teaching students about the basic ideas of IFRS. We're talking about our largest institutions, those that supply a majority of the accountants to both the public and private sector are just starting to make these changes. So those students may not be impacted for a few years down the road. So there's going to be a large knowledge base of accounting knowledge that really needs to change. It's going to be a change in CPA examinations, in academic courses, and the knowledge base of professors. So this is really going to change across the board what people are learning. Like I said, it's not a matter of if, it's a matter of when. At Grant Thornton, we're preparing, training our employees to prepare for the conversion to IFRS. We're trying to help our clients understand the basics of IFRS and how it will affect their business. I wouldn't say that we've undertaken a huge majority of this, because a lot of companies have been focusing on what they're doing right now and how things are being impacted in their current business. And I think a lot of that is guided by the SEC not giving companies that firm understanding as to when they might be impacted by the by this move. So there are going to be high costs related to IFRS, training, hiring, and transferring of staff. International companies may want to consider transferring staff to from international locations to the local U.S. office to help with the conversion. There may be unqualified and untrained staff that are all of a sudden responsible for IFRS compliance. So there is a risk of errors, and I'm not talking intentional errors, but just errors by not completely comprehending the changes. But there are some benefits, and they are that IFRS trained companies are possibly going to receive a competitive advantage as the liquidity markets recover and they continue to decrease the borders across which we reach for capital. There is an improvement that these companies may see, and they may be out ahead of others. So what are some impacts on technology? Well, most companies worldwide have reported that a majority of their transition costs were related to IT systems. This really shouldn't be a surprise to a lot of individuals. Everybody that's worked with the different IT systems has definitely seen their impact on the total cost of any types of conversion. So really it's now a good time to start to make this a cross-functional exercise that companies start to go through and understand the impact. This is not a finance-only exercise. So some things that companies may need to consider might be new data requirements. How is the appropriate information being captured? Are there new data fields that are needed? So, for example, under the IFRS, the completed contract method is prohibited. And other acceptable revenue recognition methods under IFRS may require modifications to that tracking, which I'm sure the people at Softrax are on the forefront of and thinking about how they're going to adapt those systems to meet the needs of their clients. So you see these technologies, and they're already being modified, and but there are going to be costs to some to incur, particularly to the extent that there is a lot of, if your company is using a lot of internally developed or greatly modified systems, it may be a higher cost. You might have reports that are radically changed, and how those reports are used who needs to get them, what additional inputs need to be considered. There may be increasing international regulations, just where you need to file reports, how things are done. The general system controls environment may need to change based on the changes of these technological improvements. Data retention in data warehouses. Is there information stored outside the system? Where may it need to be changed? Where can companies possibly make improvements in automated controls and processes to achieve efficiencies? But the changes to the financial reporting process should help guide not only your IT system changes, but also the changes you need to make the process and the changes you need to make to the people. It's our belief that transition with an ERP may be easier as opposed to multiple standalone systems. And if you think about it, that probably makes some sense, given that if you're really looking at moving to one system versus trying to change 4 or 5 different standalone systems, it may be easier. However, that still doesn't account for the fact that end user applications may need to be modified, and the fact, again, that controls may need to be modified to ensure data integrity. As I stated previously, XBRL were there in the U.S. from a GAAP perspective. The great thing is that there's a taxonomy that's already been developed specifically for IFRS. This will allow reduction of data entry errors, access to original company data, hopefully more timely information. Some risk and benefits of this of the technology impacts. System incompatibility. I think everybody understands different systems may not be compatible for these new accounting standards. You need to balance IFRS compliance with other regulations, whether they be financial reporting or tax reporting and the like. But the benefits should be a standardized set of training programs for all users, and the benefits over time should offset the cost of this initial transition. So some top 10 considerations. Some things that companies might want to be thinking about are understanding how each reporting entity is affected individually or collectively. Starting to create a timeline now, today, to understand what an implementation strategy might be, particularly if you're what would be considered a large accelerated filer. You may want to start considering today how you're going to be impacted, because if you look at 2014 being the first year that you'll need to file IFRS financial statements, well, you really need to look back to 2011, which is, 16 or 17 months away, which is not that long a time, because you're going to need to provide comparative information. You're going to need to look at your IT systems and understand how they're going to need to be reconfigured, or applications are going to need to be changed to impact the current accounting standards. You should probably start to think of how you can update and streamline accounting policies to conform with IFRS. Start reviewing contracts, leases, management agreements, and other contracts that may be impacted by financial ratios, revenue recognition, income tax policy, and make sure your compliance with those is appropriate. And again, allocate conversion costs in the most effective manner and control conversion cost. So Grant Thornton, obviously, we are in the business of advising our clients on different phases of this project. And what I'd like to focus on today is we're really trying to assist our clients right now with phase 1 of what we call our IFRS conversion process. It's broken down into four 4 phases. And phase 1 is just understanding how the company may need to be to account for all the different changes, whether the company really wants to take a fresh look under IFRS or do the minimal amount of changes. There are a number of different approaches from an accounting standard perspective, so that's those are some considerations that companies can be making, and we can assist with that initial diagnostic. With that, Bob, that's the end of my prepared remarks. So
that's great.
Happy to answer any questions.
We've got about 100 questions, so we're not going to get to all of them, but we'll get to many of them, and people can still throw some on the pile. We may get to some of those as well. So, well, thank you very much, John. We'll let you catch your breath for about a second, and then we'll dive right in. I have a tendency to group questions together, so you might want to get a pen and out to because some of these they coalesce around certain topics. So one of the things, the movement with IFRS around being less specific on the rules side, multiple part question here. Do you think financial statements will be easier or harder to compare under IFRS versus GAAP? And as a result of that, more less specific, do you see from a documentation perspective that people will have to document more or add more disclosure requirements to aid the user in the review of financial statements as they compare different companies?
Bob, that's a great question. I think it'll be a mixed bag the first year. I think the intent of IFRS is that it will greatly enhance the comparability across industries and across users to provide comparative information. But I think in the first few years there are going to be some major learning curve that needs to be accomplished, at least locally in the U.S. I think our international brethren are going to be a little bit advanced in that regard because they'll have already done the conversion and be a few years into the conversion.
So, and for those people asking questions about slides, I'll give you an answer to that when we're done. Most of the people have already heard about how you get copies of the slides. But as companies continue to get their hands around the IFRS principles, do you see a movement more over time that IFRS could become more rules-based?
Bob,
or crystal balls.
I wish I knew the answer to that. I could place some bets then and probably win big. I know based on all the reading I've done, it's really the intent of the International Accounting Standards Board to really try to stay away from being so prescriptive and taking that more rules-based approach. And I believe that if they stay true to that core belief, that we're not going to go down that road.
Okay. A lot of questions about education and certification and things like that. As you mentioned, and the fact that there's certainly some risk areas of and potential that people coming who have more experience in this coming to the U.S. to help. But certainly there are a lot of questions about, and you also mentioned academia and people coming out of college. Most of the people on this call are already out of college.
Right.
and so, what kind of advice initially and ongoing do you have for, accounting professionals who are in companies who have to deal with this initially on an ongoing basis, self-study, or how could they best get up to speed on this so they're not left on the side of the road?
Well, I think they can already start to read the standards, understand what is in the standards. So the great thing about the International Accounting Standards is we are used to, as a profession, financial accounting standards that can be 150, 200 pages long for one pronouncement. And if you really look at the body of the international standards, it can really fit in maybe 1 to 2 3-ring binders. So it's a lot less cumbersome. So I would encourage everyone that's really starting to lead the efforts to do a couple things. One, go out to the Internet, pull down the standards, and start to take a look at them.
And where would they go best? Where would they go for that exactly?
Well, you can go to many sources. Grant Thornton, we put out an update of changes in international accounting standards and have some guidance and the like on our Internet website. You can go out to the AICPA website and pull down their information on international accounting standards. So those are just a few resources. But I also, in the presentation, I gave some listing of some resources that companies could use. So those website addresses are in the presentation. So when people pull that down, they can certainly make use of that. And I would say it's also we are transferring the knowledge by bringing over people or reaching out to our member firms that already have people that have assisted clients through this process, either from an advisory services perspective or an auditing perspective. So I would say this is a great time to engage those who may be in the know to help assist you in understanding what might be the changes to your business.
Okay, we'll get back to some more crystal ball in a little bit, but just specifically, specific questions here from some of our customers who do a completed contract method. Did they hear correctly? What will be the effect of the completed contract method under IFRS, and will it be eliminated?
As it currently stands, it is my understanding the completed contract method will be eliminated. But I want to couch that in the fact that I am a advisory services partner, so before I'd answer that explicitly, I'd just like to go back to the standards and confirm that answer.
Okay, so they should stay tuned to that, but that's your opinion at the moment?
Yes.
A lot of questions about Sarbanes-Oxley and people who have been through that process and the effect of IFRS. What impact will that have on the way in which companies comply with Sarbanes-Oxley, or any thoughts on that, the relationship between IFRS and the work that they've done on SOX?
I think it's a great question. I do have a couple thoughts on that. The first being, if you go back and you look at the accounting policies and procedures, you really need to look at and make sure, under the international accounting standards, the desire is for companies to disclose more in the footnotes to the financial statements about how they reach conclusions, particularly around items like, let's take revenue recognition. How did they reach the conclusion that revenue should be recognized? Why did they be more descriptive? Allow the reader to really read into the thought process that management used versus the current rules-based. Okay, I had this contract and we followed this rule, therefore we recognize revenue on this method. So if you look at international standards, there's going to be that impact on the financial statements, more disclosure. But if you take that back to what people are doing on a daily basis, those accounting policies are going to need to be significantly changed. More description and more training of all the people about, downstream in that process, they're going to need to understand. And then you take that even further, it's how does that get enacted into a company's internal control structure, and what changes, what additional information needs to be changed. So it could or could not, based on the set of circumstances, which is unique for each individual company, have a major impact.
Okay. So how does the conversion to IFRS affect the FASB's current codification project? And if private companies are not adopting it, will it be two codifications? And will the U.S. GAAP still have new pronouncements? A lot in that question, but if you can break it down, that would be great.
I wish I knew the answer to that one. I think that's as yet to be determined. They're still working through how everything is going to work in those regards. And I would say you're going to get a better answer to that question when we get down the road to knowing when IFRS will be adopted in terms of how that's all going to be impacted.
Some specific questions, and to the extent you can address them, just about the IFRS effect on things things like multi-currency translation or fair value calculations or things like that. Any insight, or is that too specific at the moment?
No, the standards are definitely going to change in those regards, and where that information is going to be captured. But I think it would be misguided for me to provide an answer in that regard, because it's always particular to the facts and circumstances of the company. So I'd probably defer that without knowing more information.
Oh yeah, we don't want specific guides, but the with respect to at least those two areas, John, that they should be looking for changes with respect to
with respect to
fair value and
where the currency translation adjustment is captured, how it's captured, where it's classified in the income statement or the statement of changes in owner's equity and the like. Yes, there are going to be changes in that regard.
Okay, so so not specifically what the changes are, but a heads up that changes are coming.
Yes,
in that regard. So you mentioned people dealing with debtors and things like that. You mentioned something. We had some questions about that, about loan covenants and things like that. Any thoughts about how people are proceeding along those lines as they manage their way through this process?
Yeah, I think that's a great question. Right now, what we see some companies starting to do is if they're really being on the leading edge of things, is to think about, okay, what covenants do I have in my current agreements? How long do those agreements run? And if I'm anticipating that there's going to be a major change to the format of my financial statements, starting to engage your bankers, your creditors, and the like, so that they understand that what a ratio today is not going to be the same 5 years from now, because the format and the functions of the financial statement are going to be different. So starting to engage in those dialogues and start to discuss modifying the ratios that might be in those covenants, so that you don't get in the situation where you haven't discussed it with the banker and all of a sudden you've blown a debt covenant and it's a problem which most likely could have been avoided.
Okay. You talked about industry-specific items and gaps. So are there any industry-specific guidance for IFRS yet or to come with respect to conversion, or is it less industry-specific as GAAP? Does that make sense?
No, it definitely makes sense. What we have seen from things that have come out under IFRS is that it is less industry-driven and more of this broad principle-based. And if you look at the fact that you need to adopt really one standard for a company, even if you might have subsidiaries that are in different lines of business, it's supposed to be a more broad-brushed approach to the accounting world. So we've seen less specific guidance, but what's interesting is in the past 6 months there has been some specific guidance related to banks and financial institutions. So I would say it's hard to predict what will happen in the future as everything evolves, but I believe that they really want to stay away from the industry-specific guidance.
Okay. Can you speak a little more about be more specific about the 3-year conversion process and the dual reporting requirements? We've got a lot of questions on this, just reading one of them.
Yep.
I understand we've got to keep 2 sets of statements for the first 3 years of conversion, and lots of other questions like that. So if you could just be a little bit more specific about the dual reporting requirements for a 3-year conversion process, that would be helpful to our audience.
No problem. Well, as everybody may be aware on this call, whenever you present financial statements, and I'm going to stick strictly with public companies right now, you need to provide comparative financial information. So using the example of a large accelerated filer, 2014 would be the first year you're required to file a set of financial statements under IFRS if the current roadmap is held to. So if you take that back, that means you need 3 years of financial statements to prepare your financial statements under IFRS. So you really have to go back to the opening balance sheet of or the closing balance sheet of 2011, so that you get 2012, 2013, and 2014 appropriate numbers under IFRS. So there is definitely that dual reporting requirement. So in 2012 and 2013, you're still filing under U.S. GAAP. You get to 2014, all of a sudden you're under IFRS. And if you haven't done the appropriate planning in those first couple of years as to additional information, changes that may need to be captured, then it really is, you really are behind the 8 ball in terms of making sure you comply with things appropriately.
Now, so that's all. You mentioned public companies. So, and any, I know you've talked about private companies throughout this, but specifically to that question about the conversion process, if a private company wants to go through that process, they can if they view themselves as a future international company or a future public company or an acquisition candidate for a global company, they would follow the same thing, you think? Or?
I'd say they'd need to follow the same thing, but what a private company does not have is that line in the sand that you must file international financial reporting standards by this date and time. But IFRS does require comparative financial statements, so you're at least going to need to give yourself a transition period where you're probably doing this dual set of reporting for 1 to 2 years.
Okay, well, great. Well, that we're about out of time in terms of up against the clock, and this is more housekeeping issues. One of the things I want to let people know that on RevenueRecognition.com released today, the survey on the ISB FASB Revenue Recognition Project. A survey was shown today. A survey was released today. The findings were released today, and so I encourage you to check that out. I'm sorry we didn't get to all the questions, but we got to a lot. Thank you for that, John. If on RevenueRecognition.com, as your screen shows now, you can ask your peers many questions about revenue recognition, lots of other topics. So that's a forum that exists there. We do appreciate your time, John, and your insight with our audience today. I know it was very worthwhile for me, and I'm sure for them as well. And thank you to the audience. Bye-bye.